In this video, we're diving into one of the most advanced and important concepts in smart money trading: inducements. Inducement zones play a key role in how institutions manipulate liquidity and trader behavior. Yet they remain one of the most misunderstood parts of market structure. These areas are strategically used to create false confidence, inviting traders into setups that look perfect but are designed to fail. By learning to recognize genuine inducements, you'll gain the ability to filter out deceptive moves, identify true order blocks, and avoid falling into the liquidity traps that catch most retail traders. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now let's dive in. First, we need to understand the fundamentals of price behavior from the market structure standpoint. Price movement consists of three key submovements: impulse, corrective, and continuation. Each of these submovements includes specific candlestick patterns. Let's break down each one in detail. Impulse movements are defined by strong directional price advances within the current trend. During an impulse, the price moves assertively, often creating significant bullish or bearish trends. This phase is typically driven by strong market sentiment and a dominant force, either buyers or sellers. For instance, consider a bullish sequence of candles. As shown, the price forms a series of smaller candlestick-based impulse and corrective movements pushing upwards until it reaches a swing high. It's essential to view these bullish internal structures as a single bullish impulse leg. The reason is that price hasn't yet taken out or effectively swept the liquidity of any previous minor or internal lows. Nonetheless, from a candlestick perspective, this entire internal movement is classified as our impulse move. Before we move forward, it's important to understand why price constantly seeks these liquidity zones before reversing. Liquidity is the fuel that drives market movement, and recognizing where it's hiding can completely change how you read structure. To make this clearer, here's a short segment from our full lesson on liquidity trading strategy. So what is liquidity? Liquidity essentially means money. Every trade is an exchange between buyers and sellers. The more money flowing through the market, the easier it is for big players to execute large orders. Imagine a major company needing to convert hundreds of millions of dollars into euros. If they do it when liquidity is low, prices will soar. They want to avoid moving the market because their goal is to buy cheap. That's why they need liquidity. In other words, they need sellers in place. Now that you understand how liquidity works, let's apply it back to our market structure analysis. Next, we observe a valid pullback as the price breaks and closes below the most recent bullish candle, creating a red bearish candle known as a minor correction. Following this, we notice another impulsive move, referred to as the minor continuation. The price follows similar patterns until it reaches the swing high and forms a deeper correction in this example. Now, let's discuss the corrective movement. A corrective movement is essentially a counter-trend or retracement phase that temporarily goes against the main price direction. From a market structure perspective, in a bullish scenario, a corrective movement happens when the price breaks below the internal pullback, or internal low, or when it sweeps its liquidity with a candle shadow. In this instance, the correction is represented by these three red candles, showing that the price has broken out and swept the liquidity of the previous pullback's lowest point. Subsequently, the price pushes upwards and eventually breaks out above the latest swing high, which we then consider as a continuation movement. In a similar situation in the second candle series, we again observe the price forming a series of minor candlestick-based impulses and corrective movements upwards until it hits a temporary pause, retracing down with three red candles. Since the price has not broken the lowest point of any internal pullback or internal lows, nor has it swept the liquidity below them in this sequence, we cannot consider this a valid corrective movement. Therefore, this price action scenario should be viewed as a single impulsive movement without a correction. These concepts are equally applicable to bearish markets. It's crucial to understand that these principles can be applied across various time frames and any price action-based chart. Please ensure you watch the video carefully until the end. In the second section, we will delve into different types of inducements and the associated price actions you might encounter in the market. Now let's move on to the next topic and discuss how to identify a valid inducement in terms of candlestick patterns. We'll cover the criteria and rules necessary for this analysis. In a bullish scenario, a candlestick-based inducement occurs when the price breaks below or effectively sweeps the liquidity of the lowest point of the bearish candle, representing the most recent valid pullback. For example, in the given illustration, we observe that the price has formed successive minor and internal impulse and corrective movements before entering a retracement phase and experiencing a temporary downward movement with these three red candles. The price has broken and closed below the latest internal pullback, indicating a valid inducement and confirming the upper high as our valid major high. In a bearish scenario, a valid inducement occurs when the price breaks above or effectively sweeps the liquidity above the most recent internal pullback, confirming a new major low and establishing a new break of structure. If the price breaks and closes below the newly confirmed major low, it's crucial to note that for an inducement to be confirmed, the price must break and close above or below the most recent major high or major low, and form a valid break of structure. If you examine the bullish diagram, you'll notice that the price has broken out and closed above the latest major high, indicating valid inducements and a valid break of structure. Here, we have identified a valid break of structure. Now, after the break of structure, where's the potential inducement area? We can see that the price created an internal pullback before it broke and closed above the recent major high. In this case, the lowest point of this red bearish candle becomes an inducement. We expect the market to retrace back down, take out and sweep the liquidity below it, and confirm this high as the new major high. After mitigating the extreme demand zone, it should reverse and continue its upward direction, creating a new break of structure by breaking and closing above the most recent higher high. Before moving on to the next topic, it's essential to consider some crucial points when identifying candlestick-based inducements on your price chart. To identify a valid inducement, as mentioned earlier, the price must take out the lowest point of the bearish candle, signifying the most recent valid internal pullback. This can happen either with the body closing below or with a wick that sweeps liquidity below the candle and then retraces within the range of the lowest point of the latest pullback, as illustrated in diagrams 1 and 2. Conversely, as depicted in the third diagram, the price did not surpass the lowest point of the latest internal pullback, either with a body closing below or effectively sweeping the liquidity below it with a wick. Consequently, we cannot regard it as a valid inducement. Instead, it signifies a single impulsive movement. Now, let's understand the importance of considering inducement in our trading strategy and why it's crucial to identify and highlight inducement areas on our price charts. To illustrate this concept, let's suppose we have bullish structures simulating price movement. As you can see, the price is currently in an uptrend and has generated successive minor and internal impulse and corrective movements before entering the retracement phase and experiencing a temporary downward movement with these three red candles. It's clear that the price has dipped below the latest internal pullback, indicating an inducement and confirming a major high in this example. As the selling pressure weakens and bullish momentum resumes, the price is likely to continue its primary upward direction. Continuing the scenario, we observe that the price made attempts to push higher but failed to break the recent higher high. Instead, it formed an internal high followed by a minor internal pullback to the downside with this red candle. However, with increasing bullish momentum, the price made a strong upward impulse move, breaking the previous structural resistance and creating a new swing high. As a result, we now have a break of structure to the upside and a demand zone associated with this break of structure, located at the extreme, which has the potential to reverse the price. Identifying these inducement areas is vital, as they provide key insights into market sentiment and potential reversal points. By marking these areas on your price charts, you can better anticipate market movements and make more informed trading decisions. However, it's important to note that another nearby zone hasn't been mitigated yet, which can create confusion for traders in determining which zone to trade. There are some crucial points to consider. As we discussed earlier, the upper order block serves as an inducement zone because it's the most recent pullback created before the break of structure, and we always anticipate the price to break below it. Therefore, we should not regard that zone as a potential trading opportunity. Another critical point is that for a valid break of structure, we must wait for the price to form an inducement. Without the emergence of an inducement, we have no valid break of structure, and consequently, no valid order block for trading. In this case, the upper order block serves as an inducement, so we must not consider it a valid demand zone, as we always expect the price to take out that zone. The extreme order block is considered valid and safe for trading only when we have a confirmed break of structure. To achieve this, we need the price to form an inducement by taking out the upper order block. Only then can we regard the extreme order block as our point of interest for entering the market by opening a long position. By following these principles, traders can make more informed decisions, reducing the likelihood of entering trades in less reliable zones. It emphasizes the importance of waiting for clear market signals, such as inducements and breaks of structure, to identify the most advantageous trading opportunities. Now let's proceed to a real chart and integrate all the concepts we've explored in this video. We'll examine how to effectively identify valid inducements in the market. Here we're looking at the Euro-Dollar 15-minute time frame. As you can see, the market's overall momentum is bearish. In this scenario, the price has formed internal bearish impulses and pullbacks until it entered a temporary pause and started to push upward. We see that the price pushed upward, taking out the most recent pullback and indicating a valid inducement. With the emergence of a valid inducement, we now have a confirmed major low. Additionally, there's a valid break of structure as the price has broken out and closed below the major low. And the recent break of structure confirms this lower high as the most recent major high. By observing this chart, we can clearly see how these concepts apply in a real market scenario. The inducement and break of structure help us identify potential trading opportunities and confirm key levels. This approach can improve your trading accuracy and confidence. Remember, consistent practice and thorough backtesting are essential for mastering these techniques and developing a robust trading strategy. Let's identify the next potential inducement zone linked to the recent impulsive movement. As mentioned earlier, a candlestick-based inducement occurs when the price breaks below or effectively sweeps the liquidity of the lowest point of the bearish candle, representing the most recent valid pullback. We need to locate the latest internal pullback within the impulsive movement that led to the recent break of structure. This candle represents the latest internal pullback. Our expectation here is that the price will push higher, take out the highest point of the candle, form an inducement, and then continue with the bearish momentum. Moving forward, let's see what unfolds next. The price pushed higher, but couldn't surpass the high of the latest internal structure, failing to form an inducement, and is now attempting to move to the downside. Therefore, this lower low is not confirmed yet, and we cannot consider it as a major low. Following this, let's continue and observe how the price action unfolds. At this point, the price has pushed to the downside, breaking out and closing below this structure. However, this does not constitute a valid break of structure because the price couldn't form a valid inducement before breaking this structure, and this structure is not a valid major low. Consequently, we cannot consider this break of structure as valid. This price movement acts like a single impulse movement. From here, we see that the price has created internal pullbacks within its recent bearish impulse movement. This candle signifies the latest internal pullback. Our anticipation here is for the price to rise higher, surpass the highest point of the candle, create an inducement, and subsequently resume its bearish momentum. Additionally, examining the upper internal pullback, we can pinpoint this order block, which holds a higher probability compared to the lower order block that we view as an inducement rather than a valid order block. Subsequently, our approach is to patiently wait for the price to push higher, surpass the latest internal pullback, sweep the liquidity of the inducements order block, validate this lower low as the new major low, and subsequently confirm a valid break of structure. By adhering to this method, traders can more accurately identify key levels and potential trade entries, enhancing their overall strategy and decision-making process. Patience and precise analysis are critical in successfully navigating market movements. Given that the price has successfully executed a valid break of structure, we can pinpoint a supply zone associated with it. We believe this zone holds a high potential to prompt a reversal when the price approaches it. It's crucial to note that without a valid break of structure, we cannot identify a valid order block. In conclusion, mastering the identification of inducements is essential for improving your trading precision. These zones, often engineered by institutional players, are designed to lure retail traders into traps. By learning to recognize valid inducements and true breaks of structure, you can filter out false signals, identify authentic order blocks, and align your entries with institutional intent rather than against it. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.